The US national debt sitting at $36 trillion. Well, here's a post that Trump made on Truth Social, December 29, 2024. And he couldn't be more spot on here because the extension of the debt ceiling by a previous Speaker of the House, a good man and a friend of his, from this past September of the Biden administration to June of the Trump administration will go down as one of the dumbest political decisions made in years. There was no reason to do it. Nothing was gained. We got nothing for it. A major reason why the speakership was lost, it was Biden's problem, not ours. Now it becomes ours. He calls it the 1929 because the Democrats don't care what our country may be forced into. In fact, they would prefer depression as long as it hurts the Republican Party. The Democrats must be forced to take a vote on this treacherous issue now during the Biden administration and not in June of this year. They should be blamed for this potential disaster, not the Republicans. So if Trump is calling this a 1929 crash, we need to pay very close attention here because look at this, a load of debt. The Treasury has about $7 trillion of debt to refinance in 2025 as bond yields are marching higher again. So you guys can see in blue here, this is the maturing debt coming in the summer of this year, and then it tapers off by 2026, 2028, 2030, etc. Now, this is super important because the debt ceiling and gross federal debt in the U.S. from 1981 to 2023 in trillions of dollars has risen irrespective of who's been in the White House. And they like to place blame on both parties. You know, Republicans like to blame Democrats, Democrats like to blame Republicans, and it just creates division in the country. So we need to look at the bigger picture here because in green, you can see the debt ceiling suspensions where they just push it back, they kick the can down the road. In purple, we can see extraordinary measures to exceed the debt ceiling, which happened under the Biden administration. And in red, you can see Republicans in office and Democrats in office. And so while the Republicans were in office, they just suspended the ceiling. Same thing for Democrats as well, too. Nobody wants to deal with the problem because it is so big. And the problem is not necessarily the U.S. national debt, although it is a big problem. It's $36.5 trillion. It's the interest on the debt, because when we look at the bond market right here, you guys can see, as the US 10-year Treasury notes have dropped in price, will bond yields go up because they're inversely correlated, obviously. Well, the interest on this debt alone from the year 2000 over the past 5 years has risen so much because of the bond yields rising. If we see the bond yields rise even more, then the interest on that debt is going to be so out of control that they will never be able to cover their bills. And the only thing that they can do is simply raise the ceiling and print more money. Otherwise, they have to default on their debt, which has never happened in the history of this whole debt ceiling situation here. They've always suspended it or raised the ceiling. And just recently, extraordinary measures were called into effect to raise the debt ceiling. So this is one of the craziest times in human history. And so here's what we need to look at. The 10-year Treasury constant maturity minus the 2-year Treasury constant maturity that basically maps out the difference between the 10-year yield and the 2-year yield. So if I pull up on the top of the chart, you guys can see that the 2-year is at 3.995%. And the 10-year is at 4.3%. So if the 2-year continues to fall while the 10-year either stays where it's at or goes up, what we will see is this yield curve inversion go further into the positive, because when we are inverted, meaning we're just below zero in the negative here, like we were in June of 2023 when it was negative 1.06, well, that's when the 2-year was up here at like 4.5% and the 10-year was right here at like 3.6%. So there was a difference of negative 1.06%, which is why we were in the steepest yield curve inversion since all the way back here in the 1980s. So this is why Trump is calling it 1929, because the past 5 times that we've gone from a yield curve inversion to spiking back in the positive, we've seen a recession marked in. And you can see this gray vertical boxes here as a recession. The last one was really quick, and this was a government forced one just because they locked everyone indoors. So it was pretty quick. But then they signed the CARES Act into law. They printed a lot of money. So it wasn't really that long of a recession. The previous one was in 2007. You can see we went from like negative 0.11. And then once the recession got marked in, but was the financial crisis of 2008, 2009 during the subprime mortgage crash. Before then, we were like negative 0.45, and then the recession was called in by like March of 2001 and then ended by like November of 2001, while the yield curve was going drastically back into the positive, and the 10-year started outperforming the 2-year. And then the time before then was after 1989 going into 1990 and 1991. Then before then, we were in 1981 to 1982. And there was a couple recessions in the 80s. The other one was like 1980 to July. So from January to July. So it's no doubt about it that things are looking pretty iffy right now because we just went from negative and we're in the positive right now. So a recession, in my opinion, right around the corner. I think it's coming this year. And I think we'll see it as the 10-year starts to outperform the 2-year, and we'll see the 2-year start to drop even more than where it's at right now at 3.99%. We see this descending resistance right here. We broke this uptrend. Since the 3rd of May, we are forming higher highs and higher lows. So you can see this ascending support right here. We broke it on the 1st of July of 2024. And as you can see here, there was support at like 4.1%. We crashed down. Now we're bouncing back up into the support as resistance. And I just expect the 2-year to continue to the downside. Now, that doesn't necessarily mean that the 10-year is just going to go up even more. The 10-year could drop. It would just drop slower than the 2-year. Because if we draw this ascending support right here, we can see that the 10-year did something similar. It broke below this ascending support, and now it's bouncing back up to retest it. Even though the bounce was higher than how much the 2-year bounced, we're now seeing it pull back to the downside. So this is going to take some time to play out for the 10-year and the 2-year while this yield curve inversion spikes even more into the positive. And what will affect this will be what the Fed does with their effective federal funds rate. So the Fed has a dual mandate. They adjust the effective federal funds rate based on what inflation is showing and based on what unemployment is showing. So inflation came in lower from January. As I showed you guys in my video yesterday, I talked about how the data is actually much lower. And I believe in March, it's going to come even lower than February, signaling the Fed to cut rates here soon. And we'll see if that happens. But that's my expectation, because if you guys didn't watch my video yesterday, go check that out. And I talked about this right here at about the 23-minute mark. And you guys can see on this chart that shows truthful data for a transparent economy. And if we zoom in here, you guys can see in January of this year, we were all the way up here at 3%. Sure enough, January came in at 3% right here on tradingeconomics.com. But then look after that, what happened in February, we dropped down all the way to about 2%. And then we saw it bounce at the end of February going into March. And then Trading Economics clocked that in at 2.8%. So that's why a lot of this inflation data is fugazi, but nonetheless, it's coming down because look at where it's at in March. It spiked all the way down to like 1.4%. So we might see a bounce here and maybe it closes at, 2% to 2.8%. If that data is accurate and it comes in lower, then that would get closer to the Fed's 2% target. Now, the challenge here is the dual mandate because unemployment needs to stay beneath 4.2%. Jerome Powell said I believe it's 4.4 is what they're watching as a recession indicator, because if I zoom out on Max, this has a 100% hit rate where the unemployment has spiked. It's signaled a recession the past 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 out of 12 times going back to 1948. So if this has a 100% hit rate, this is the most important thing that we need to pay attention to then. So over the past 10 years, we saw the last time that this took place was February 2020 till April. That was COVID. Everyone was locked indoors. Of course, they couldn't work. So unemployment spiked from 3.5% to 14.8%. But if we zoom in recently to where we're at right now, we can see unemployment ticking up from April of 2023. It was at 4% for January. It came in at 4.1 in February. So depending on where it comes in at for March, if it ticks up, then that will determine what the Fed does for their effective federal funds rate. So on the CME group right here, we can see expectations for the next meeting. 98% are expecting the Fed to keep rates current. So the majority are not expecting a rate cut for this FOMC meeting in a few days from right now on the 19th. Well, the 7th of May, we can see 82% are expecting them to keep it flat again. 17.6% are expecting a rate cut. And it isn't until June that those numbers drastically swing in favor of a 25 basis point rate cut, 68.8% by June. And coincidentally enough, that is right when the $7 trillion of debt is set to be refinanced. As Trump said right here on Truth Social, December 29th, calling for the Democrats to take a vote on this issue now and not in June, when Trump's administration has to basically decide what to do for that load of debt that's maturing. Now, in regards to the 2% inflation target, Bill here, who's the founder and CEO of Abra Global, the leading crypto asset manager and prime broker that provides institutional clients, including hedge funds, venture capital firms, crypto ATMs, and miners with a comprehensive suite of trading services for hedging, lending, treasury, and liquidity management. Well, he says the bogus 2% inflation target is generally a function of lifespan. Over 50 years, 2% inflation lowers the value of your cash holdings by 67% off the top. So living to 130 creates a big problem for the inflation fraud. The inflation fraud no longer works as the value of your holdings falls by over 85%. So he says the solution is obviously Bitcoin, because inflation is just a hidden ghost tax. Because think about it. Let's just say you make $100,000 a year. We'll take into account taxes. Maybe you're left with what, $80,000, not including your mortgage, your cell phone bill, your food for your kids, all the stuff that you have to pay for gasoline and other expenses that you got to cover. Let's just say you have 80 grand left and you only paid $20,000 and you lived on TV dinners and you didn't spend that much money. You didn't travel anywhere. You have no kids. Well, if you saved $80,000 in 2020, well, in 2025, that cumulative rate of inflation hits you at 23.3%, meaning you've lost 23% of the spending power of $80,000, and you would need $98,000 to afford the same amount this year in goods and services to afford the same lifestyle with the same income, let alone go back to the year 2000. Let's just use a dollar as an example to simplify it for you guys. 85% of the spending power has been lost over 25 years. So that's inflation tax. It is the slow piranhas that just eat away at your skin, and they don't kill you right away, but it kills you over time. And so if their goal is 2%, that's best case scenario if they have it under control. What happens if they don't have it under control? You're screwed if you save dollars. Stack that on top of the IRS tax. Well, SEC's Lutnick says Donald Trump's goal is to have zero taxes for anyone making less than $150,000 per year. Having tariffs on other countries is much better than overtaxing people in the United States to pay down this interest on the debt from their unlimited print orders that the Fed and the Treasury are issuing that caused this $36 trillion in the first place. I mean, do you guys agree or do you disagree with that? Do you want them to tax you more? Do you want them to take more of your money that they're already taking that you don't even see from inflation? Or would you rather have other countries pay that tax and you pay zero tax so you can finally start making more money? Bill here saying, y'all never change. Bitcoin is now experiencing its 11th 25% correction in 10 years. And every time everyone reacts like the sky is falling, and every time everyone screams that it's different this time. And so in my video yesterday, I talked about this, showing you guys every single major correction that happened back in 2017. And those corrections were even bigger than the ones we're going through right now, between 30 to 40%. So stacking it up side by side with that bull run puts things in perspective, because this pullback looks, smells, and feels 100% just like 2017. To Bill here, rising fiat liquidity leads to massive asset price gains. So right now, the new admin has decided that we need, number one, lower treasury rates to refinance the debt. Number two, lower mortgage rates to unlock the housing and CRE markets. And number three, lower treasury rates to save banks from their collective insolvency. So China is in a deep recession and needs lower US rates to support its own money printing regime, and print they will. And we're likely going to see massive job cuts via government cuts, tech cuts, and house-related cuts. At the same time, ISM will likely rise for the next several months. All of this tells us liquidity will continue to flow, and the markets will do what they always do in this type of cycle. That liquidity will flow into stocks, Bitcoin, crypto, and real estate for a blow off top before a major crash happens. So once again, buckle up. And when we look at Bitcoin versus global M2, global liquidity, we can see that global liquidity started to tick up while Bitcoin is experiencing a pullback. Now, as you guys know, global liquidity moves first, and then that starts to flow into, risk on assets like crypto or like the stock market or even real estate or precious metals as well too. So we're due for a pump here soon with inflation coming down. And if inflation ticks down again for March, then with the Fed cutting rates, the next step would be the Fed adding to their balance sheet, because over the past year, the Fed has been tightening. So this makes it more difficult to predict the markets, because with total assets in millions of dollars retracting, meaning the Fed is selling assets, well, they've been doing this since the bear market. So we've seen the first little taste of a bull run while the Fed's been tightening on balance sheets. What happens if the Fed starts adding to their balance sheet while lowering the effective federal funds rate, while global liquidity ticks up? I think that would be a melt up in the market, and we would see a blow off top before the crash happens. So a lot of people are calling for the top to be in right now, but I don't think that's the case. I think we have another bounce in us this bull run this year before a crash happens. And what does this mean for altcoins like XRP? Well, Linda P. Jones said, Bitcoin is the greatest distraction from the greatest disruption that is coming to financial services. Well, she actually quoted Franklin Templeton, CEO Jenny Johnson here, because they filed their S1 document for an XRP ETF. So if he's saying that Bitcoin's the greatest distraction and they're filing an XRP ETF,